I'm Robert Maltbie with Maltbie's Minute on the Market. Happy St. Patrick's Day. Good Irish luck, green ale, and subsequent brawls, because we're going to need that kind of vigor right now with the looming big battles ahead between higher interest rates and earnings growth. First, a bubble check versus the year 2000. At current levels, we're 20% below on a price to GDP, 5% below on a price to sales, and at a 50% discount on relative valuations based on earnings per share yield. What about these exploding debt levels that many pundits point to? Are they really exploding? No, not really. We have the strongest levels on balance sheets based on debt to equity ratios of the Millennium, down from 68 to 52%. Expect the trend to continue from the tax cuts as this boosts earnings growth and reduces the attractiveness of more debt. A possible negative effect is a big source of buying power. Corporate buybacks may be losing their attractiveness based on the reduced impact of the tax shield. Now for the good. Earnings growth has been exceptional. The effect of the corporate tax cuts adds to that growth, and we're looking for an 18% jump up this year, a big number. The technical picture looks very, very good as breadth expanded and has held up during the bounce back, and all the major indices hold up nicely above their 200-day moving averages. With earnings yield at relative parity to the corporate BBB yield, valuations do seem reasonable. So, we're wondering if individual stocks look the same. Now, with rate hikes ahead, how are we looking? Our indicators forecast a 2% T-bill rate, roughly 1.5 rate hikes. If that turns out to be conservative and we get 4 or 100 basis points higher, that could compress the PE ratio market to 16 times 2018 earnings. That would give us a floor of about 2,600 on the S&P, a downside of about 5% from current levels, which is about where we went in the February correction. If we assume 2019 earnings of $170, 175, and use our 18 multiple, we could see 3,100. That's what we feel fair value is by the end of the year. That's roughly a 14% total return. So, based on the facts and the estimates and the indicators, we're going to give the bulls a nod with a total return upside of 14 versus a 5% downside. Advice: buy the dip. Sectors we like: financials and technologies. For more information, visit millennium-asset.biz. Happy green ale. Go Fighting Irish. Go earnings over interest rates. I'm Robert Maltbie with Maltbie's Minute on the Market.